Hi everyone, I'm Eugene and this is Finance Talk. Today we will speak about stock dilutions and understand, are they really bad for the investor? You will understand how companies make these moves and why do they issue more shares on the stock exchange. You will also know about different red flags which help you to understand whether the stock dilution will be or not, and it will save you a lot of money. Stay tuned. But before we start, I would recommend you to subscribe to this channel and hit the like button for great confetti. As a community, we can grow faster and acquire valuable skills in investing, finance, and business. Thank you for doing that. And now let's start. First of all, let's understand what stock dilutions really are. In simple words, these are situations when the company issues more stocks in a certain period of time, making your share as an investor less valuable. In this case, you as an investor earn less money on your investment capital. And in comparison to other investments, this move will significantly decrease your rate of return over the long period of time. Here is the simple example for you to understand the logic. Suppose we have the company which is called X, and it has $5 million in market cap and earns $1 million in net revenue every year. The company has three partners which are equal, and every partner has 33.3% in the stake of the company. So every year, each shareholder receives $333,000 as net profit. But the business is great, the business model is stable, and the management wants to improve its revenues. And the CEO of the company decides to buy the competitor, his technologies, in order to gain more share of the market. But in order to do that, the company requires additional capital. The company management decides to sell the portion of the company to the fourth investor, splitting the shares between all four people. So in this case, every person, instead of 33.3% of the company, receives 25% of net earnings of the company. So most of you can say that now every investor has less share in the company than it was before. And technically you are right, but does the revenue for every particular investor in the company decrease? Let's find out. So when the company raised the capital, the management bought technologies of the competitor, which helped to increase revenues of the company to 2 million. So in this case, every investor, instead of $333,000 in net earnings per year, will receive $450,000, which is more than it was before. So in this case, the stock dilutions worked really well, and every investor received the benefit from it. Next, let's understand what are the reasons why the company issues more shares on the stock market. There can be several of them. First, as we spoke above, the management of the company needs money to buy the competitor or acquire any assets which will benefit the company in general. And management can do it in two different ways: buy with cash or buy with stocks. The great example here is the purchase of WhatsApp by Facebook, which is currently Meta, in 2014. The company bought the startup for $16 billion in total. $4 billion was in cash and $12 billion were in shares. In this case, there was a stock dilution, but as a result, investors got more value from this operation than they previously had. Second reason for stock dilution is to pay off debt. So when the company has high long or short-term debt, it can issue additional stocks in order to raise capital and pay off all of that. The great example here is IMC stock. The company has more than $10.6 billion in total debt. So in 2021, the company issued 300 million more shares in order to pay off all its obligations. So your initial investment in the company was cut in more than 3 times. Third reason for stock dilution in the company is the special incentive programs for management and its employees. Usually the company can pay different bonuses to top managers for achieving particular results. This can be stock options or stocks with a discount. And this concept is also applied to the company employees. For example, Apple gives the option to invest 10% of employees' salary to Apple stocks and buy them at a 15% discount. Also, top management receive shares as bonuses for achieving company results. It also needs to be said that both stock options and stocks can be taken as stock dilutions. Now, let's understand what are signs of future stock dilutions in the company. This information, from my point of view, can save you thousands of dollars and help you not to make wrong investment decisions. First red flag, as we spoke above, is the high level of debt. You can go to different websites like Wall Street Journal, finviz.com, or just annual reports in order to look for that number. Personally, I look for situations when the company doesn't have a lot of debt and it doesn't exceed the total current assets of the company. So if something goes wrong, the company would have enough cash to pay off all its obligations. If you see that the company has high long and short-term debt, high debt to equity ratio, this can be a red flag for you. Next, I look for shares outstanding and diluted shares outstanding in Dynamics. For that, I go to annual report of the company in income statement and look for those numbers. Diluted shares include convertible preferred shares, convertible debentures, stock options, and warrants. In this case, we can compare both numbers and later understand the incentive policy, how the management structured that, etc. Next, I look for earnings per share and diluted earnings per share in the company. For those of you who do not know these metrics, they simply show how much money the company will make in net earnings per one share. For me, these are one of the most important indicators in evaluating the future stock dilutions, because even if the company issues more shares in current or future periods, but the earnings per share or diluted earnings per share increasing, it is the good sign for you that the management allocates capital well, they structure their debt, and you as an investor receive more benefit from stock dilutions. If you see the opposite picture, then we can say that you receive less money on your investments. The great example here is Meta Platforms. I go to Wall Street Journal markets and open income statement of the company. And as we can see, the company decreases the number of shares outstanding. And these are both basic shares and diluted shares. So in this case, it is beneficial for the shareholders because you as an investor receive more money on your current investments. And also we can see that the company increases their earnings per share, which is also beneficial for the investors. Next important indicators for me are return on equity and return on assets. They show how well the company manages the money they have. For those who do not know, to calculate return on equity, you take net income and divide it by average shareholders' equity. For return on assets, you take net income and divide it by total assets. The higher the numbers, the better situation for you. For those ratios, I usually go to finviz.com in order to understand the dynamics and understand the general information. Personally, I carefully analyze stock dilutions by the company. And for me, the good indicator that the company continues to buy back its shares, and even if the management issues more stocks on the stock exchange, the return on assets, return on equity, and earnings per share will increase for me as an investor. That's all for today, guys. I hope you enjoyed the video and it was useful for you. If so, please leave a like and subscribe to the channel. If you have any questions or ideas about my future videos, please write them down in the comments below. Thank you for watching and bye.